Hello. This presentation is our analysis of ExxonMobil for strategic management at MTSU. In this analysis, I, Amelia, will discuss strategies that ExxonMobil is using to achieve their business objectives. Kat will then analyze the external and internal environment of Exxon and its markets. Brennan will cover significant financial information. And finally, Erika will discuss strategic concerns pertaining to Exxon's current operations and any recommendations for maintaining its status as a market leader. First, we will discuss ExxonMobil's business objectives and the strategies they are implementing to meet those objectives. ExxonMobil is a large, well-established corporation. Its main business objective is to become the world's premier petroleum and chemical manufacturing company. Their goal is to continuously achieve superior financial and operating results while adhering to high ethical standards. Exxon separates this massive goal by focusing on the different groups of stakeholders in the company, including shareholders, customers, employees, and communities. These 4 action items come from Exxon's own strategy to achieve the previously stated objectives. Exxon is employing a deliberate strategy by planning and executing solutions for both current and future concerns in its industry. This includes mitigating emissions in company operations, developing and deploying scalable technology solutions, providing products to help customers reduce their emissions, and proactively engaging on climate-related policy. Let's look at the strategies that Exxon is either actively pursuing or that would fit well in their current internal structure and external market. On a corporate level, ExxonMobil uses a vertical integration strategy to control all of the steps in its business processes. It separates its operations into 3 areas. Before 2021, Exxon's business divisions included upstream, which encompasses research and development of its exploration and extraction processes. Its downstream division was what most of us know Exxon for, refining crude oil and selling it through retail service stations, also known as gas stations. The chemicals division, which contributed to 13% of revenue in 2020, focuses instead on the conversion of fossil fuels into usable chemicals and compounds, mostly for other businesses. Exxon actually breaks down some of its financial information into these 3 business divisions. In 2021, ExxonMobil created a new structure for its 3 main divisions in order to better align with society and industry trends. The company is still using its upstream division to spearhead research and find where it can cut cost in production. And upstream still makes up the largest part of revenue, about 70%. Exxon consolidated both the downstream and chemical divisions into product solutions, because they both focus on creating products for customers. The newest division, Low Carbon Solutions, focuses on reducing emissions from the company's own operations. These solutions are then also shared with society as a whole. This includes carbon capture, hydrogen, and biofuels. Entering the biofuels market is a form of related diversification for Exxon, as they are already part of the broader energy market. ExxonMobil manages the extraction and refining processes all the way to the sale of final materials. This strategy of vertical integration has helped them remain a successful, low-cost leader, discussed next. ExxonMobil is already a leader in the gas and energy market, but like many other companies today, it has dealt with unexpected obstacles in the past several years. It combined its downstream and chemical divisions into one. These businesses share the same raw material, crude oil, and contributed to approximately 1/5 of operating profit in 2019. Exxon vowed to cut $6 billion from operating costs by next year after suffering historic losses in 2020. They also combined their technology and engineering operations, which were originally assigned to individual business units, to form a new single technology organization. If Exxon can reallocate resources and cut operating costs, they will be closer to their objective of being the premier petroleum company in the world. ExxonMobil operates across the globe as Exxon, Mobil, and Esso. They currently operate in 58 countries across the globe, shown in red on the map to the right. Because the energy market is heavily influenced by both economic and political factors, Exxon even recruits from government agencies to help in its global operations. Because of Exxon's large focus on research and development, Their global strategy can ensure that the company continues to incur cost at a suitable level and that many processes are standardized, which allows for immense volumes of production and distribution of Exxon's products. As the CEO describes, if Exxon's operations and services are centralized, resources needed can be appropriately allocated. Overall, ExxonMobil has implemented multiple strategies to adapt and find continued success throughout the years, which continues to be seen in their efforts to restructure their company.
In order to chart a company's strategic course wisely, managers must develop an understanding of the company's present situation, which includes the external environment. As part of the SWOT analysis, the external factors concentrate on the opportunities and threats of these factors. Understanding the external factors can help management understand what questions to ask and how to better develop and analyze their strategy to match their outside surroundings. One of the 6 components of the macro environment is the political factor. One opportunity for Exxon associated with the political factor is the tax advantage being offered for shifting to alternative energy sources. Another is the clean energy regulations have given Exxon the ability to reinvest in its biofuels division. However, the threat of these political factors is the increased expense for compliance and the applied carbon taxes. These could lead to increased costs in production and a decrease in the return on investment. The second component of the macro environment is the economic factor. In 2020, COVID-19 presented many opportunities and threats to the company. Although Exxon saw a large decrease in demand for oil, causing significant losses, it was able to use its other raw materials for production. It converted the raw materials into a high-grade polymer face shield that could withstand repeated sanitization for repeated use by healthcare workers. The last component of the macro environment discussed is the technology factor. After the attack on the Colonial Pipeline, the CFO of Exxon stated its employees go through simulations of cyber attacks. This helps the company stay prepared and aware of the threats. The cyber attack on the Colonial Pipeline shows what could happen to Exxon if another attack were directed towards its own plantation pipeline. The internal environment assesses the company's resources and organizational capabilities. Analyzing the internal environment helps managers determine whether their strategy is likely to give the company a competitive edge over rival firms. This portion will focus on the strengths and weaknesses of the SWOT analysis. Exxon has invested heavily in its research and development of biofuels. It is the last of the big 3 companies to continue the algae research, with Chevron and Shell both discontinuing theirs. This has allowed Exxon to become the leader in development and partner with research firms like Viridis. However, the algae research is more expensive and specialized in comparison to other renewable energies such as wind and solar. Exxon's focus on training and maintaining its workforce is shown through its Houston campus. The campus offers continuing education and a research lab to keep employees' knowledge current in the field. Exxon's benefits have maintained a high retention rate of employees throughout the years. During the COVID-19 pandemic, Exxon's decrease in profits led to layoffs of many of these employees, causing mistrust and backlash. Because ExxonMobil has been around for 135 years in one form or another, it has a very definitive brand value and recognition. The value of the branding itself is estimated to be $19,222,000,000. It placed 4th in brand recognition alongside other giants like Royal Dutch Shell and Chevron. ExxonMobil currently has several litigation claims and lawsuits pending, and it has been shown that this negative publicity has directly impacted its profits, causing losses. This concludes the SWOT analysis of ExxonMobil.
Hello, Professor. This is Brennan Ballard, and I will be taking over for the discussion of financial analysis. Before we begin, I would like to say, all the financial data used to arrive at these ratios were taken from the ExxonMobil 2021 annual report. Industry averages mentioned throughout my presentation of this data reflect discoveries through my own research and the industry standards and averages for 2021. I will walk through the different ratios and the overall indication when compared to industry averages, or the quote-unquote ideal ratios discussed in the textbook. I will begin with profitability ratios. The first thing to notice is that ExxonMobil is performing better than average in most of the profitability ratios when compared to competitors. The only exceptions being gross profit and the return on equity calculation, which still manages to fall on the high side of the average range. Overall, these ratios indicate strong profits and returns on investment. Next, I will discuss leverage ratios. Again, these ratios indicate smooth performance for the most part. There are 2 that stand out to me. The first being the coverage ratio, which indicates that ExxonMobil can cover their interest obligations approximately 34 times from operating income alone. This, combined with the relatively low long-term debt ratios, show that Exxon would be able to take on more debt if necessary. However, Exxon has a relatively high debt-to-equity ratio, indicating that they should avoid taking on much more debt if they would like to stay under 1.0. Lastly, the liquidity and activity ratios. Even though the current ratio is greater than 1.0, meaning Exxon can cover their obligations in the unlikely event of a full liquidation, the quick ratio is revealing. While they have enough current assets in total to cover a total liquidation, they would not be able to do so without selling a majority of their inventory, leaving approximately $3 billion worth of inventory after full coverage. This is not necessarily a bad thing, as the inventory turnover ratio indicates a reliable turnover on inventory throughout the year. Given the turnover ratio for both inventory and accounts receivable, Exxon will not have trouble selling refined or crude oil if it really came down to it.
Now we will cover 3 main areas of concern for ExxonMobil. Those are global concerns, operational concerns, and corporate concerns. Exxon has announced plans to discontinue operations at Sakhalin-1, an offshore project in Russia where they run 3 oil and gas fields. They hold a 30% stake in the project and are anticipating losses of assets valued at $4 billion. Wind and solar power have become affordable replacements to fossil fuels. Both have the ability to provide electricity. In 2021, they made up 10% of the world's energy source, and that number is expected to grow by at least 60% by 2026. Most car companies are working to provide affordable electric car options, and in 2026, oil demand is forecast to drop by 1.1 billion barrels a day. The demand for ethanol and renewable diesel are expected to triple by 2026. This is largely due to government support of these energy sources. Exxon is investing a large portion of money into carbon capture and storage. Carbon capture aims to contain carbon pollution where it's created. It supposedly captures 90% of carbon emissions, but a study out of Stanford says that number is closer to 10% due to the carbon created to run the carbon capture equipment. Exxon announced a plan to cut costs by $6 billion in 2023. This will be done by consolidating operations throughout the company. They will also be moving their headquarters from Irving to Houston, Texas by mid-year 2023. This move could result in job cuts and the loss of qualified employees who don't want to relocate. Exxon suffered major losses in 2020 but continued to pay dividends to its shareholders. They even borrowed money to make it happen. Their debt was increased by almost $21 billion that year. Engine number 1 is a newer activist investment firm that scrutinized the board's lack of knowledgeable, green-friendly members. They suggested 4 potential members to be elected, and shareholders listened. 2 of their prospects were elected despite the CEO of Exxon's disapproval. I will now move into recommendations for the 3 areas of concern that I covered in the 3 prior slides. My recommendations for Exxon's exit from Sakhalin-1 are to explore options to sell its 30% stake in the project to mitigate anticipated losses. Exxon should continue monitoring the war and anticipate any other operations that may be affected. Exxon should take advantage of tax incentives offered by governments. They should invest more funds into cleaner energy sources such as wind and solar and expand their operations into biofuels. Exxon should continue improving on the carbon capture process and also explore other opportunities such as carbon removal. My recommendations for ExxonMobil as they plan to move their operations from Irving to Houston are to start the search for qualified employees now. They can also reduce the burden of employee losses by offering attractive compensation packages for current employees to relocate. Exxon should continue paying off the debts they incurred during 2020 and should also remain mindful of the shareholders' focus on environmental social governance. This concludes our discussion of ExxonMobil's strategic concerns and recommendations.
This concludes our group's video analysis of ExxonMobil's strategy, environment, financials, and areas of concern. Thank you for taking the time to watch our presentation.